Hi, I'm Max Keiser. This is the Keiser Report. Well, Jamie Dimon, CEO of JP Morgan, has opened his pie hole again. Stacey Herbert?
Yes, Max. Your favorite friend in New York City?
He's back here somewhere! Behind me! We know he's there! Let's get a posse together and go roust him!
Well, last Wednesday, in fact, he was at the New York Fed along with a bunch of other CEOs of the banks. Dimon cites give and take after bank chiefs meet at Fed. JP Morgan Chase and Company Chief Executive Jamie Dimon said there was give and take when bank leaders met with Federal Reserve officials to discuss industry oversight in New York last week.
Oh yeah, well, we give, he takes. You know, the little tapeworm.
Hi, I'm Jamie the tapeworm. Any money for me to steal today? Whoop.
And then Obama says, we can't look back. We have to go forward. Let's pass laws to make it easier for tapeworms like Jamie to steal money.
Hi, I'm Jamie the tapeworm. Any more money for me to steal?
And then he goes back into the warmth of his lair, his fecal-encrusted lair where he lives with his little family of tapeworms.
Hi, I'm Jamie. I want to steal more money. My stock's worth a zero, but I need more money because I'm a tapeworm named Jamie Dimon. Yeah!
And lenders, including New York-based JP Morgan, the largest and most profitable U.S. bank, are resisting Fed efforts to impose tougher restrictions on too-big-to-fail firms whose collapse could hurt the broader economy. The banks have pressed the Fed to explain assumptions used on this year's stress test and have criticized the central bank's proposed rules, including limits on counterparty risk. Now here's what Jamie Dimon says. It's great that people get together and collaborate, talk about the facts and the analysis, all the interest in having a great financial system. The better we do here, the better it will be for the U.S. economy.
Well, let's get something clear. First of all, they don't make profits. They are gifted money from us, the taxpayer, and the savers who take money out of our pockets and stuff it into his pocket. But he doesn't make money in the classic sense that he's competing. He doesn't compete. All the too big to fails got too big to fail more. They're bigger. They're not failing even on a grander scale. The competition's wiped out. That's not called competition. That's not even American. What Taliban group is Jamie Dimon from? What frickin' jihadi is he working for?
So anyway, he says the better we do here, i.e. Wall Street, the better it will be for the U.S. economy. So I wanted to go back and look at the charts to see the percentage of finance as percentage of the GDP, and then compare it to how the U.S. economy is doing. Well, here's a chart that goes back to 1860, and that shows the finance sector as percentage of GDP. And you can see that it peaked at 6% in 1929, and then promptly the economy collapsed. And then it peaked at 8% in 2007, 2008, and as we know, we have collapsed, but we've gone nowhere down to the mean of 2% as a percentage of GDP.
Well, because of the miracle of medicine and science, Stacey Herbert, we now know that 99% of all tapeworms have Jamie Dimon's face. We know that. We look under the microscope of a tapeworm, comes out of a schwing of some house or somewhere in China, and there's Jamie Dimon's face peeking up from us. I'm a tapeworm. I'm a parasite. Give me more money, because I'm a greedy. I was born in a greedy petri dish of greed. My parents are greedy, no goodness. I live for the stealing of your money. I'm a pathological, psychological tyrant. I steal. I steal, therefore I am. Jamie, tapeworm, Dimon.
And then, Max, you mentioned stealing. From Simon Johnson, we have from 1973 to 1985, the financial sector never earned more than 16% of domestic corporate profits. In 1986, that figure reached 19%. In the 90s, it oscillated between 21 and 30%, higher than it had ever been in the post-war period. This decade, it reached 41%. So they're getting more and more of the profits. They're shaking down all the corporations, not just us, but the corporations as well. They're shaking down everybody and taking more of the profit.
Oh yeah, that's at the tapeworm of their business model, of stealing, of larceny, of turning a healthy economy into a cancer. It spreads throughout the corporate world. So General Electric, for example, most of their money comes from Jamie's tapeworm program. So Jeff Immelt is doing the,
Hi, I'm Jeff Immelt. I like Jamie tapeworm, so I'm a tapeworm. Woo!
And this goes on and on and on. And so all these corporations are basically mimicking because there's no law. If Jamie Dimon can print this money without having to answer to any laws whatsoever, why shouldn't General Electric, why shouldn't Exxon, why shouldn't any of these companies, Apple Computer, do the exact same thing? If no one's going to enforce the law, what incentive is there for any of these corporations to obey the law? There is none, because there's no Justice Department, there's no leadership.
Well, that's a very good analogy to the tapeworm, because the tapeworm lives inside you and you don't feel sick, you don't feel ill, nothing seems bad on the surface, but underneath they're actually taking all the nutrients that you require to actually build over the long term, to live over the long term. So with these tapeworm likes of Jamie Dimon, as you so eloquently demonstrate, you know, the economy is becoming sicker and sicker and sicker until it just drops dead one day.
That's right. You walk on the streets of New York, people are like, oh, I don't feel good. Oh, I feel very sick. I'm not sure what it is. They have Jamie tapeworm. They've got Jamie tapeworm syndrome. Their entire lives are being eaten out from inside by this greedy little tapeworm named Jamie.
Yeah, but that one day you're just going to see this entire skyline behind us, Max, fall, collapse.
You know, and the risk is that people from other countries like Asia come and eat the people that have collapsed on the street, then they get the tapeworm. Oh wait, I think that already happened.
Okay, so we have this big sort of roadshow going on. It's like a carnival, right, where they're pretending. I think it's pretend, this whole fake meeting with the Fed and Jamie Dimon out there, putting his face out there, Lloyd Blankfein. They're all concerned about this 10% counterparty risk number. They're saying it's a big deal. But there are other people who are also suspicious, Max. Parsing bank lobbyists' dire warnings on derivatives rules. The derivatives market is concentrated in the hands of a tiny number of large banks. Just 4 banks account for 85% of total credit exposure to derivatives at American banks. JP Morgan Chase, the largest derivatives bank, has $348 billion of total credit exposure from derivatives. It has capital plus bad loan reserves of $219 billion. Therefore, using the 10% exposure threshold envisioned under the new rule, JP Morgan won't be able to have exposure of more than $22 billion to a single entity. But that may be a hard ceiling to achieve in the concentrated derivatives market, since $22 billion is only 6% of its derivatives exposure.
Right, and the market cap of the entire company is roughly, what, 150, 160 billion. So the equity of JP Morgan stock is worth goose egg. If you're buying JP Morgan stock, it's a suicide mission. Just blow your brains out, and it's a lot cheaper.
Well, of course, it's possible that the lobbyists were exaggerating their findings to make the impact of the rule to look more severe than it would be. Predicting dire scenarios is common in letters opposing the financial overhaul. In fact, the footnotes accompanying the exposure study did flag areas of imprecision. As a result, exposures under the new rules may turn out to be much lower than lobbyists say, and implementing the rules that would therefore not be disruptive. Now, the Fed did these stress tests, and 15 of the 19 of the banks passed in an extreme scenario, even while still maintaining their dividends. So how is that possible? And this is what the lobbyist group for the banks is arguing, that they need to see this formula from the Fed, that 4 of them failed this stress test. Well, 100% of the banks in the United States failed the stress test of 2008. So who are these 15 that pass this time?
Well, the stress test is Ben Bernanke's under stress, because Jamie puts a gun to his head and says, either you shut up and stop this talk about minimum capital requirements, we're going to blow your brains out. Look, the minimum capital requirements that banks are supposed to follow, let's call it Basel III, whatever the international requirement is, they're in violation of. I'll say that with no bones about it. They violate that, been violating that for years. Same thing with JP Morgan, same thing with all these Wall Street banks. They break the law every single day. Dimon would break the law going to the men's room. He's a serial lawbreaker. How he's not in jail is the beauty of the Obama administration, to protect the guilty. It's a remarkable achievement.
And I know you're speaking to Chris Whalen in the second half, but Basel III, you know, U.S. banks, as Yves Smith from Naked Capitalism points out, they never followed Basel II. They never adhered to that. So why they're making a big brouhaha? I think it's really just a dog and pony show. I think they're pretending. There's Obama, he's the dog barking around, going across the United States saying, I'm being tough on the banks. And Jamie Dimon is playing his role, especially if he wants to be Treasury Secretary. He has to pretend, oh, Obama, you're being so hard on us. Why are you doing that? And so it gives legitimacy to Obama's claim that he's being hard on the banks, and therefore Jamie Dimon can be Treasury Secretary.
The whole argument comes down to the value of collateral. Whether it's money that's on the balance sheet, that's tier 1 capital that can be used as collateral to borrow 100 cents on the dollar, or if you're a rehypothecation scandal in London, you can borrow infinitely against that collateral, that tier 1 capital, or in the US it's 140%. But then they get into the minutia of debating, well, what is tier 1 capital? I mean, we have it here in this segregated account, which we've just shown that we can rip off at any time, so it's not really a segregated account, so you can't really call that tier 1 capital. Maybe it's tier 2 capital or tier 3 capital. Maybe it's a tiara that Jamie wears to bed every night while he's licking, you know, the entrails of his tapeworm providing fecal matter. We don't know the exact details. But what I can tell you is that the last time in history we've had such nonsense when you've got 3 or 4 cardinals sitting around discussing how many angels can dance on the head of a pin. When you talk about these bankers discussing what's the real collateral value of our tier 1 capital. It's just your law breaking. How about that? Go to jail and eat some slop because you're a criminal. How about that?
Well, finally, you mentioned fraud, and I have a headline here. MF Global implosion. Congressman Grimm sends a message. So this is from Janet Tavicoli. In January, MF Global began work on a crisis plan called Stress Scenario Analysis, Downgrade Potential Impact on MF Global. It wasn't completed until around 18 days before the bankruptcy. MF Global worried that it wouldn't have enough cash and liquid assets of its own to meet calls for collateral, i.e. margin calls, among other things in the event of a ratings downgrade. Then she points out, Max, that the document poses a question on page 11. MF Global is asking itself, how quickly do we want to send cash back to clients? What is the message if we do not send immediately? So she's looking at this document that MF Global wrote for a year before the collapse. And one of her banking friends said it reads like a fraud playbook.
Yes, it's fraud, the playbook of Lehman Brothers. We now know, shortly before the collapse, the executives, Dick Fuld, took $700 million. Oh, they didn't report that to the SEC or any regulatory body. They just stole the money. So MF Global, JP Morgan say, well, they're not going to prosecute Lehman Brothers, so we'll just do the same thing with MF Global. It'll collapse, but before it collapses, we're going to steal $250 million because there's no law. It's against it, because theft is legal. Yeah, here's a nickel dance. Sad, very sad. Okay, Stacey Herbert, thanks so much for being on the Keiser Report.
Thank you, Max.
Don't go away, much more coming your way, so stay right there. Welcome back to the Keiser Report. I'm Max Keiser. Time now to turn to Chris Whalen, Senior Managing Director of Tangent Capital. Chris Whalen, welcome to the Keiser Report.
Thank you, Max.
All right, Chris Whalen, what has the Fed done to our economy?
Well, what have they done? They're basically trying to keep everything the way it was in beautiful stasis. This means no debt reduction, no taking apart the big banks, and no going after the people who ran the big banks and did all of the various acts of fraud that we've seen over the last 8-10 years. The Fed is really the bad guys here, unfortunately, because they are trying their hardest to stoke up inflation, but we have a deflationary scenario at the moment. So they're kind of fighting the last war. And you know, as much as we tell them, look, you really need to let interest rates go up a little bit so the banking system doesn't collapse next year, but they don't seem to want to hear this. So I would characterize it as the Fed fighting the last war. I think that's the best way to describe it. But they're also not really interested in restructuring and renewal, which is the only way we're going to get any job growth in this country or, you know, globally, really.
So, Chris, the Fed is enabling these too big to fail banks to pay off the coupons on the bonds that they hold, but in terms of viewing these bonds as collateral on the balance sheets of these banks, they are continually being impaired, correct? I mean, the collateral, the balance sheet of these banks is collapsing, but we don't see it because the Fed keeps allowing them to pay off the coupon or the interest rate, so it looks on the surface like, oh, everything's great, but underneath the surface it's crumbling, correct?
Well, correct, because, you know, most banks, if you think of how they make money, about 1/3 of their profits comes from carry. In other words, just interest rates that they earn on assets, on your money, on other people's money. So that's been taken off the table. Since the Fed is keeping rates at zero in an effort to stoke consumer activity, they say, what we're really doing is taking income, taking earnings potential out of banks, out of insurance companies, and particularly out of the hands of savers. If you look at the people who did the right thing in our society, they're being punished, and the bankers are being facilitated and subsidized. So there's a political and an economic dimension to what we're doing here that I don't think people fully understand, because look at Morgan Stanley. Look at all the distress that that firm is in now. A big part of that is because they're not making any money on their inventory. Same thing with Goldman Sachs. So all the securities they own, all the bonds and everything else that they have, they hold for customers, they can't lend that out. They can't make money on it because of the Fed's zero rate policy. So we're, in effect, I think, almost stoking the fires of deflation through the Fed's policies. And I really am very concerned about where US banks are going to be a year from now, because if you think of it, you know, I own part of a rating agency out in California. The first quarter of last year was the best quarter we've seen for US banks since the crisis. So we've essentially been going sideways, and we're even seeing signs of deterioration in terms of operating leverage, things like that. So a year from now, if we keep these policies in place, I think you're going to see some real problems in the U.S. banking sector, concentrated in the biggest banks.
All right, let's talk about one of those banks, Wells Fargo. They made a big move into New York in the commercial and residential mortgage market, ostensibly for the fees. But when you drill down a little bit, what you find is that just like this carry that you discussed in terms of the interest and supporting the assets to support the interest, the fees are just there to mask a deteriorating earnings picture. And isn't this Lehman Brothers all over again?
Well, it is. I've been very critical of Wells Fargo. They had their CFO depart last year very suddenly without explanation. I think their accounting is suspect. I think they're very aggressive in the way that they book fees. For example, if they wrote you a mortgage today, Max, not only would they price that mortgage half a point lower than any other bank would make that same loan to you, but then they'll say, well, we're going to sell Max another 3.5 products from the Wells Fargo platform. Let's figure out what the total value of Max is this quarter and book all the profits that we're going to earn from him over his lifetime relationship with Wells Fargo this quarter. That's .com accounting. That's phony baloney in my book, and I think Wells Fargo is a poster child for accounting fraud. I really do. I've had problems with their disclosure from day one, and I don't care if they've got Warren Buffett in their shareholder list. It doesn't matter. I think it's too good to be true what they're showing you with the SEC filings, and I think if you talk to other banks about the way Wells Fargo is behaving in the marketplace today, it raises real concerns. This bank has almost 1/3 market share in the national market for mortgages in the United States. All the other big banks, Max, are well below 10%. They're withdrawing from the market. So Wells Fargo is the last man standing in this marketplace for mortgages, both commercial and residential.
Well, let's talk about somebody who has become the self-anointed representative of the too big to fail banks, a man who's got $90 trillion on his balance sheet of derivatives and other unsecured liabilities. I'm speaking, of course, of Jamie Dimon at J.P. Morgan. He is arguing with the government that he needs less regulation, he needs to be able to increase the amount of leverage he has on his books, and he needs the swaps market deregulated. So just for those out there in the international audience, just briefly explain a swap and then what's Jamie's problem?
Well, Jamie's problem, I mean, in some respects, I agree with him when it comes to Basel II and III and all the rest of it. Dodd-Frank is a disaster. We're actually hurting the U.S. economy with all of these initiatives they're kind of like Calvinist punishment, really. We're going to punish the big banks because we bailed them out. That's one part. The derivatives and everything else with J.P. Morgan is very important, because if you look at Jamie Dimon's unregulated over-the-counter derivatives business, it makes the bank pale by comparison. The bank's almost a trivial concern. So, you know, he's talking about two very different things. One is, do we want to put more regulation on credit creation in the U.S.? Answer is no. The whole Dodd-Frank construct, I think, has to be revisited. But when you look at over-the-counter derivatives, they're not regulated at all. Jamie Dimon got everything he wanted out of the over-the-counter derivatives negotiations for Dodd-Frank. So I don't really see what more he could possibly ask for, because the banks have wired the bankruptcy laws. If you look at MF Global, look at Madoff, even look at Lehman Brothers. In every one of those cases, the over-the-counter derivatives market was subsidized by the other creditors. They're given special treatment. They're not subject to the automatic stay in bankruptcy, et cetera, et cetera. So OTC derivatives is already a special ghetto, and I don't know what else we could give Jamie Dimon to satisfy his concerns.
Well, a quick note on this Jamie Dimon character, because he, like all other bankers on Wall Street, having worked there myself, and he exemplifies this idea that he will do what he wants to do, and if he breaks the law, well, the problem is that the law needs to be changed. When it comes to Basel II or Basel III, they're saying, well, you know, these requirements, reserve requirements, we don't really think they're consistent with what we think the law should be, so we're going to do whatever we want to do, and you can pass a law if you want to, but we don't have to answer to anyone's law. I mean, that's a very bad example, isn't it, Chris Whalen?
Well, it's not just banks, though. If you think about it, the stock corporation is the problem today. Big corporations are not accountable to their shareholders, and they basically do whatever management wants, but we don't have shareholder democracy in this country. We still have an indirect kind of democracy, much like our political system. So big companies tend to be antithetical towards openness. They tend to be antithetical towards democratic processes, because big corporations are fascist by definition. And so when you get into this whole area of regulation, you know, Jamie Dimon is caught between his investors on the one hand, who still aren't valuing JP Morgan sufficiently so that the stock is trading above book value. And then on the other hand, you have the regulatory community who says, oh, we need more capital. When people like Sheila Bair say this to me and say, oh, Chris, don't you agree with us? We need more capital. I say, no, we have to stop doing stupid things. But the problem is that if we had a more sane financial market, banks like JP Morgan wouldn't be that profitable. Jamie Dimon has to take a lot more risk than we really want him to in order to hit those earnings targets for Wall Street. So he's kind of caught in the middle. And you have to understand that dynamic, because he lives in terror that the buy side is going to move out of his stock, and then the bank is trading at half a book value. Jamie Dimon then loses his job. So those are the interconnects here. It's not all just about public policy. It's about the big institutional investors who own JP Morgan stock.
Right. I understood about this point about corporate governance in general being bad in the U.S., and banks fall under that category. However, the financial sector has gobbled up a huge percentage of the overall profits of the economy. It's the one industry that now is driving the U.S. economy in many ways. But I want to ask you about another fraudulent situation. MF Global, if you can talk on it a bit. You're in the money management business yourself, Chris Whalen. Has the crimes committed by MF Global impacted your business?
When I'm out marketing our new hedge fund, one of the interesting comments I get is that clients don't want to put money into the fund, and they certainly don't want to use a broker-dealer as a custodian because of MF Global, but they'd like to have their money managed by my group in a separately managed account that's custodied with a big bank. So what MF Global has done is essentially destroyed broker-dealers as independent custodians for customer funds. And since we haven't prosecuted anyone, you know, John Corzine was one of the biggest financial supporters of President Obama, but there's no sign that this man is going to be prosecuted for what seem like obvious acts of fraud. You know, in my business, if you don't safeguard customer funds, you're guilty of fraud, and you could be prosecuted. It's 5 years, $5,000 per count. Barack Obama refuses to prosecute the wrongdoers, and MF Global is a grotesque example, Max. I mean, it has done more damage to Wall Street and more damage to the credibility of Wall Street firms vis-a-vis big institutional customers than anything I can think of.
Now, Chris, you're currently managing money, as you mentioned, and you've got a real specialty in the banking sector. And the reason I bring this up is that people say after the crash of 2008 and et cetera, that of course the entire sector they paint the entire banking sector with a black brush that it's all corrupt. But of course, that's not true. The too big to fail banks are in a separate category. There's a whole nother world of banking out there that when people say, well, we couldn't just let these banks crash, could we? And well, yeah, because there's a lot of other banks that are competent that could have picked up the slack that the government could have just handed the ball to the banks that weren't breaking the law, right? There's plenty of law-abiding banks in the country, aren't there?
Well, there are, and you know, you always got to factor in the cowardice and the inertia of the regulators. They don't want to be bothered breaking up a big bank. I'm not talking about my friends at the FDIC, who I think would enjoy it, but the Fed, the comptroller, the other regulators, they just live in terror of the idea of breaking up a Bank of America or a Citibank, but it has to be done. I've said for a while, I think we talked about it on this show, Max, that we should break up Bank of America. You could end up with 5 banks the size of U.S. Bancorp. And it would help the competitive atmosphere in the market. It would definitely help to turn those assets back into useful assets that could generate employment, generate growth in the economy. But the politicians are so cowardly and so craven, and they're bought off too, we need to say that they don't want to go into these institutions even though they have the legal power now and restructure them. So we're just going to muddle along, and you have more than half of the banking assets in the U.S. basically locked up inside these zombies. So that means the economy is going to drag.
All right, Chris Whalen, we're out of time. Thanks for being on the Keiser Report.
My pleasure. Thank you, Max.
All right, and that's going to do it for this edition of the Keiser Report with me, Max Keiser, and Stacey Herbert. I want to thank my guest, Chris Whalen. If you want to send me an email, please do so at keiserreport@rttv.ru. Until next time, Max Keiser saying bye, y'all.